I have with me Praveen and Ranga, the CEO and CFO of Infosys. Praveen and Ranga, thank you for joining us on Bloomberg Quint. To begin with, Ranga, so capital allocation question, and that's the biggest thing which I think markets are also looking at more clarity on it. You mentioned the word up to 13,000 crores, and that's creating a thing that maybe it will be much lower than that. Can we get us the certainty of whether it will be in buybacks or is it going to be additional dividend payouts?
Well, I think if you look at our capital allocation policy, it has laid out two core pieces. It says clearly that we have considered the strategic cash requirements that the company needs over the next couple of years, as well as the operational cash requirements. After ascertaining that, it has announced this capital allocation policy. It has two components. One is the first component says out of every $100 of free cash flow that the company will earn in future years, how much are we going to retain, how much are we likely to return to the shareholders. It says up to 70%. Even if you look at our current dividend policy, it says up to 50% of the PAT.
But isn't that coming to 63% of the free cash flow as of today?
That's right. If you look at the fiscal 17, that works out to 63% of free cash flow. Now coming to the second one, the capital allocation policy also addresses, first was out of the future cash flow. Now the balance sheet cash that we have close to $6 billion, how much does the board expect to return in this fiscal year itself? That's where it is up to 2 billion or up to 13,000 crores. As we know, and they also indicated what are the mechanisms. It could be dividend, it could be a part of the share buyback. We are listed on multiple global stock exchanges, whether it is New York, whether it is London Euronext, Paris Euronext, and we are expected to comply with all the regulatory requirements in those places on the capital return. Likewise, we have a large global investor base. So the board will certainly indicate both the mechanism as well as the quantum in due course after obtaining after looking at these or complying with all the regulatory requirements. So I think the policy, the intention, the mechanisms are pretty clear in the capital allocation policy.
Praveen, your utilization rates went up this quarter, but on the whole, the revenue per employee has been stagnant at $51,000. I know Mr. Sikka spoke about the fact that 30 employees which are contributing to 45% of revenues, their revenue per employee contribution is much higher. But when are we going to see the blended rate to go up? Because that's what is one of the visions which you have for 2020 as well.
See, first thing is it actually increased 2%. It's not flat. When you compare with last year versus this year, revenue per employee has increased by 2%. So trajectory wise, it's in the positive direction. There are three parts to when we look at this question. One part is of course the business, the core business, core IT services, where we are seeing a lot of commoditization, pricing pressure. So there we are focusing a lot on automation. So there the focus is to do more with less and for more kind of thing. So that is one part of it where we have seen some early signs of success, and that's something we'll continue to do that. The second part is the new software business that we are talking about. On a very small base, as Vishal said, we are seeing it more than $100,000 per person revenue productivity. It's on a small base, but our aspiration is to take it for that to be a big percentage of our business over the years. So when that starts kicking in, you will see a much bigger impact. Third part is even in our core business, there is a big percentage of our core business on new services, and if you are able to grow that portfolio much faster, because these come with higher margins and higher revenue productivity. So it's a combination of three. One part of the business we have to focus more on automation and driving productivity up and doing more with less, and also try to drive growth in services which are of high profitability, high margins kind of thing. And the third part is to drive our software thing. So we are confident that it will trend in the right direction, but difficult to say when it will reach what at this stage.
You spoke about several headwinds, that's why which led to broadening of the band for margins from 23 to 25%. My question is couple of them. At a time when you should be looking at the vision of 2020 where you are looking at 30% margin margin, you should be say that okay, from 24 we'll try to look at 26. You're becoming 23 to 25. That's one concern which the street has, and so they're not able to figure out what kind of headwinds exactly and what kind of impact it will have. Of course, there will be wage impact and others which will be there, and onshore activities which you mentioned there. But my point is, what kind of capex you're looking at in onshore kind of thing, where you're going to set up more DCs and other infrastructure there, and is there a upside to the margin?
Well, I think as we have always said, we have broadened the margin range. If you look at last year, we ended up at the higher end of our margin guidance. We said 24 to 25. Last couple of quarters we have been saying 24 to 25. We ended up the year at 24.7, higher end, which is pretty much same as the previous year. That was despite the pricing, the declines, the revenue trajectory, cross currency. But we focused laser sharp on the operational efficiency. Like utilization is all time high for Q4. It is 82%. Likewise, the subcon as a percentage of revenue is 5.6. It has come down from last year. Likewise, on on-site employee cost as a percentage of revenue, a little over 38%. It has again come down. So I think there has been a lot of focus on operational efficiency to counter the other impacts. So we are very happy that we could deliver at the higher end of the margin guidance. For this year, we broadened it 23 to 25. The purpose is very simple. One is the rupee, which is essentially has appreciated a little over 3.3%, and that is one factor. We have to watch how the trajectory of the rupee, and we have to navigate that. The second part is really on we also want to make sure that we have sufficient investments in the United States by way of on-site DCs to attract local talent, so that we address some of the potential the risks there. So while these two are there, it doesn't mean that we will not focus on the operational efficiency. There are headrooms that we want to work on, whether it on-site mix, for example, we're at close to 30%. So on-site mix is something that we want to focus on, which essentially means more of offshoring, so that the on-site mix comes down. For every 1% in on-site mix reduction improves the operating margin by about 40 basis points. So these are some of the levers that we want to look at. Likewise, some headroom in utilizations on the on-site employee costs and things like that. So the margin band is wider. However, our relentless focus on this would improve. One encouraging sign that we had in FY17, of course, we have to continue to watch it, is really the per capita revenue. If you look at the net headcount added during fiscal 17, which was about 6,000 people, as compared to close to 18,000 people previous year, is just 1/3. So in other words, the rate of growth of revenue is higher than the rate of growth of headcount addition. So that's something, how much of is it utilization led, how much is it automation and productivity led, is something that we want to watch, but that's an encouraging sign. So we want to see how much that we could accelerate in the current year. So the range is broader, but these are all some of the things that we need to look at.